Hi, this is Chiro. In this video, we're going to talk about investing in Fisker Inc. as of October 2020, which is planned to reverse merge with Spartan Energy Acquisition Corporation, ticker SPAQ, which is a SPAC. If you enjoy this type of content, consider hitting the like button and subscribing. I'd appreciate it more than your savings account appreciates in today's low interest environment. Fisker Inc. currently trades under the ticker SPAQ. If and when a merger happens, the ticker will probably change to something more related to Fisker. But that begs the question, what is a Fisker? Fisker Inc. is named after Henrik Fisker, a Danish-American designer of luxury cars. He's founded a few companies, one of which is Fisker Automotive, which attempted to produce a luxury plug-in hybrid vehicle in 2008, but ultimately declared bankruptcy in 2013. Henrik claims to have learned a lot from this bankruptcy, and intends to use partnerships with companies like Volkswagen to do the actual manufacturing. These partnerships aren't in place yet, which is a huge risk, but if successful, this is probably a good way to lower the cost of entry into the field. Fisker Inc.'s product will be the Fisker Ocean, an all-electric SUV claiming to be the world's most sustainable vehicle, featuring a 250 to 300 mile range, vegan interior, recycled materials, and a unique flexible lease. If I haven't sold you on this car yet, just give it some time. 2 years to be precise, because deliveries are starting in 2022. Personally, I see Fisker Inc. as a pre-revenue company with a meh product, albeit with a niche, but what's the worst that could happen? Jokes aside, I do see potential for this company, and at a minimum, the business plan plays to Henrik's strength as a designer. Before we discuss investment strategies, remember to smash the like and subscribe buttons on this video, and that this video shouldn't be taken as investment advice. Also, while I have some investments in SPAQ, I'm not sponsored or otherwise affiliated with these companies. The strategies we're going to look at today are buying shares, buying warrants, selling at the money puts a couple months out, and a combination of buying a warrant and selling a long-dated call. While the price of each of these strategies will change over time and will depend on what strikes or expiry dates you choose for the options, the approximate initial investment per share at the time of recording are shown as an example. Anyways, prior to the merger occurring, the downside is more limited. SPAQ is effectively a shell company comprised of cash intended to fund Fisker Inc. at a rate of about $10 per share, so this can be treated as the worst case scenario if the merger doesn't go through. At a share price of $10, you'd lose about $5 of your $15 if you bought shares, but if the merger goes through, you stand to gain as much as the shares increase by. If the merger goes through, the cash is now Fisker's though, and that comes with a risk of what I'll call Fisker bomb, or bankruptcy, where in the worst case you could stand to lose the entire amount invested. If the company breaks out, there's still no limit to its success though. I personally think there's better ways to invest, but it is a simple and easy way to invest in Fisker. Now, if you buy warrants, you need a much smaller initial investment, and assuming the merger goes through, you'll have the option of paying an additional $11.50 to purchase a common share. If the merger fails, you lose your entire investment though, as the shares will be unlikely to remain above $11.50. If the merger passes, however, you stand to gain almost as much as buying a share, minus about $1 since you're effectively buying a share for $5 plus $11.50. Post-merger, assuming you exercise your warrant, you'll basically own a share, so the payoff is again just slightly worse than buying a share. While warrants currently offer a slightly lower payoff, I would prefer warrants to buying shares because you don't have to tie up the extra $10 per share. As a side note, if the common shares skyrocket in price, it is likely that buying warrants will become a cheaper option than buying shares. Now on to selling an at-the-money put that expires a few months out. This strategy is nice because you don't have to put down any upfront capital, but I would definitely recommend not over-leveraging and being capable of covering the potential of an early assignment, that is, the strike price of the put per share. Having said that, if you did get assigned, you could always sell any shares you get assigned, and unless the merger fails, causing the shares to tank back to $10, you'd really only be losing $1. The main downside to this method is that your upside is limited if Fisker soars beyond your strike price. If you sell a put that expires after the merger goes through, the premium you receive will probably be more, but if Fisker goes bankrupt before your put expires, you still stand to lose a little more than you did pre-merger. Your upside remains capped post-merger too. I'm not overly excited about the company or its prospects, but I think it has enough promise for a merger to go through, so I'm fine with limiting my upside to greatly decrease my potential pre-merger downside. So this is actually how I've taken a position in SPAQ. Lastly, I thought of a cute but mostly unnecessarily complicated strategy that probably won't result in an unexpected bankruptcy. At the time of recording, a super long-dated and out-of-the-money call costs about the same as a warrant, meaning that if you sell the call and buy a warrant, you break even or maybe even earn $1. In this case, if a merger doesn't go through, you lose nothing, or even come out slightly ahead. The scary thing about this strategy is if, prior to the warrants becoming exercisable, shares skyrocket way above your strike price to say $100. If this happened, you could expect to get exercised, even though the call was long dated, and will now be on the hook for way more than you hope. In theory, you could immediately rebuy those shares, but this still isn't risk-free and isn't something I'd enjoy knowing could happen. Once you exercise your warrant, however, you stand to gain any amount up to the strike price of your long-dated call. I like the great potential upside, seemingly low downside of this strategy and not needing any upfront capital, but the potential to have a life-ruiningly bad time scares me. And that's my take on Fisker Inc. Let me know your thoughts in the comments below. If you enjoyed this video or learned something, consider tapping the like button and subscribing to see future content. Anyhow, thanks for watching and have a great day. Meaning that if you sell the